are students in the Experiential Learning course for Business Consulting at the University of Idaho. Today we'll be going over a few parts of accounting that are important for startup businesses. To start, what is accounting? Accounting is the recording, analyzing, and reporting of financial transactions. It is the process of making financial data understandable and useful for the business and its stakeholders. Accounting is important because it provides information about performance, financial position, and cash flows of a business. It is important for managing a business and also securing investors. Our presentation will cover the necessities for establishing a business. We will also define important accounting terms, introduce a few software options, and go over how to prepare a budget and financial statement.
Hello, my name is Brendan Gilliland. I'm a senior accounting major. For this portion of the presentation, we'll be going over some of the most common types of business structures, employee identification numbers, how to register with the state, and the difference between company employees and subcontracted employees. For business structures, the most common types, the first is sole proprietorships. These are the most common types of businesses and do not require any special filing. All that is required for sole proprietorship is registration, and you're the sole owner of the company. The advantages are they're the simplest form of structure. You as the business owner have full autonomy over your business decisions and easy tax preparation. Taxes are done under the Form 1040, Schedule C. The disadvantages are you are fully responsible for your business's success and are fully reliable for your business's actions. Your personal assets are at risk if you are liable. There's no legal separation between you personally and that of your company. It can be hard to raise money for these types of businesses. Banks are skeptical of sole proprietorships because of these liability issues. So why would one choose a sole proprietorship? If you have a low-risk business, which means the likelihood of lawsuits for malpractice, damages, or similar are low, or if you want to try out an idea before committing significant resources, a sole proprietorship could be right for you. The next type are limited liability companies or limited liability partnerships. LLCs and LLPs are organizations that provide a personal shield for your personal assets, such as homes, cars, savings accounts, etc., from litigation. LLCs and LPs, which are limited partnerships, have to pay self-employment taxes. LLPs do not. The advantages are the tax and liability shield of your personal assets in most cases. For LLCs, profits and losses can get passed through to your personal income without paying corporate taxes. Another advantage are these types of business structures have limited lifespans. The disadvantages are the tax and liability shield is limited. You are not judgment proof. Some states require an LLC or an LLP to be dissolved if an owner leaves the organization. So why would one choose an LLC or an LLP? They're good for group organizations that are at higher risk than sole proprietorships. LLCs and LLPs come with increased protection of personal assets, separating them from business assets. Also, like sole proprietorships, your group could use this to try out new ideas before reorganizing into a larger entity, which is made easier by the limited lifespan. The last structure that we're going to talk about is an S corporation. S corps are in between of limited liability companies and your standard C corporations. To become an S corp, there are certain requirements that you must meet available through the IRS at irs.gov. S corps avoid some of the double taxation issues of C corporations and provide some of the LLC benefits, such as allowing some profit and loss to go directly to your personal income. The advantages, you have a similar tax and liability benefits of LLCs. You avoid potential double taxation of the C corporations. You have an independent life, unlike the LLCs. You can write certain deductions off as business expenses. And if an owner leaves, the organization does not have to close and reform. The disadvantages are the IRS eligibility requirements for formation. You have to run stricter operations, must be ran more like a standard corporation. You have shareholders and compensation requirements, and have different state taxation requirements. Why would one choose an S corporation? You have increased tax benefits over C corporations or LLCs. You have an independent life, which allows for growth and easier change of leadership. The next topic are employer identification numbers, or EINs. This EIN is used for paying taxes. If you pay employees, file taxes, operate as a corporation or a partnership, work with certain types of organizations, or have tax withholding, you need an EIN. To obtain an EIN, go to the IRS website at irs.gov. And in the search bar, enter Get EIN or Apply for an EIN. And follow the Apply for EIN link. It should be the first one on the results page. For the state of Idaho, all you need for the federal EIN, all you need is the federal EIN when registering. The Idaho Tax Commission at tax.idaho.gov recommends having the following when filing for your EIN. If you have any available EINs, Social Security numbers or other EINs for all of the owners, partners, and officers, a physical and mailing addresses of the business, date the business began in Idaho, and any dates of incorporation, if applicable, information on your expected employee count, first paycheck dates, hire dates, etc. For state registration, within the state of Idaho, you need to go to the Secretary of State website at sos.idaho.gov and then create an account with the SOS Biz. On top of the home page, there will be an icon for business services. Hover over it until a drop-down menu appears, then click on Business Filings. It will take you to a new page. Once on this page, click on Forms, which will be on the left-hand side menu. Search for the type of business you want to incorporate. At this point, if you have not created an account or logged into an existing account, you will need to do so. If you need or want help in figuring out what documentation you need for filing, on the home page for the Secretary of State, at the very bottom is a list of services provided. Find the column Business Services, which should be on the far left-hand side. Then under Hours, there will be a hyperlink labeled Corporations, LLCs, and ABNs. Click on this and it'll send you to another page. On that new page, scroll down until you see the portion labeled Small Business Development Center. There will be two links. The first is the Business Wizard, which will help with registration, organization types, and special requirements or concerns for your type of business. The second is the Resource Wizard, which helps with narrowing down the resource options available and tailoring your results for your specific questions. For employees, there are two main types of employees, a W-2 or 1099 employee. A W-2 company employee, the W-2s are designed for employers who withhold income, Social Security, and or Medicare taxes. If you have employees who have filed a Form W-4, employees withholding certificate with you, you will need to file Form W-2 wage and tax statement. For Form 1099, if you have subcontracted employees or employees who you did not withhold taxes for, then a 1099 would be filed. There are limitations and requirements that must be met for a 1099. The main one is if you paid someone who is not a W-2 employee $600 or more for business-related services, which include parts and materials. An example of this is if you hire an independent contractor for some facade work on your business front. The total due for parts, materials, and labor comes to $650. You would use a Form 1099 MISC to account for this. There are many 1099 forms available. Each variant has its own purpose. MISC is miscellaneous income. NEC is non-employee compensation. INT is interest. And for a full list of variants and regulations regarding these variants, see the IRS website. Thank you.
Hello, my name is Casey Terwilliger, and I am a senior accounting major here. First, I will be discussing basic accounting definitions that will be presented throughout our presentations. Financial statements refer to the written reports which show the financial condition and performance of the firm. The four types of financial statements are the balance sheet, income statement, statement of cash flows, and the statement of changes in equity. Revenue is money received through the sale of merchandise or services. This generally is incoming cash. Expenses are cash expenditures for the business operations, which include salaries and any other costs you may have. The balance sheet shows the financial condition of a company at a specific point in time, using the company's assets, liabilities, and equity. When referring to assets of the company, these consist of things that the firm owns that are worth value, such as cash, accounts receivable, inventory, and equipment. Liabilities are items that the company owes to outside individuals or organizations, such as accounts payable, interest payables, and notes payables. Lastly, for the balance sheet is the owner's equity section. This section shows the owner's initial investments in capital and investments from accumulated profit from the previous years and the current year. Moving on to the income statement, this statement shows the company's performance during a fiscal year. Included are profits for the company by selling goods or services, as well as the expenditures the company must pay to create those products. The next statement is the cash flow statement that shows the cash inflows and cash outflows from the activities of operating, investing, and financing. Double entry is a term that refers to the accounting practice that for every change in an account, there is a corresponding change or changes to accounts or other accounts. Certified public accountants, commonly referred to as a CPA, is an individual who has passed a CPA exam and has maintained their standings as a CPA, such as paying their dues and maintaining their continuing education. CPAs are generally registered in the state that they practice. Now I will be discussing journal entries and how they are written. Journal entries are essential for maintaining accurate records of the company's financial status and aiding in decision making. To do this, we use a double entry system. Double entry means that for every account that changes, a corresponding account must change as well. For example, you get a loan for $10,000 to purchase new equipment. You gain $10,000 in cash, but now you are liable to repay that loan, so your notes and/or accounts payable account increases as well. This helps you keep track of where your funds are coming from, why they came from there, and where and why they are going out. To record these transactions, we use ledgers and journals. The ledger, commonly called the general ledger, tracks 5 main accounts: assets, liabilities, owner's equity, revenue, and expenses. These 5 accounts are needed for preparing your financial statements and are a summarization of your accounts. Journals break down the 5 main accounts and track specific information. Journals are separated by account numbers and specific account names such as cash, rent, expense, equipment, supplies, accounts receivable, and accounts payable. The standard format for journal entries is column-based by the date of the transaction, accounts affected, and debits and credits. When entering your transaction, at least one debit and credit amount will be recorded, starting with the debited accounts. Debit and credit accounts are always used in accounting and are used in reverse from what you would hear from a bank. A debit is when an asset increases or a decrease in liabilities or equity. A credit decreases an asset and expenses or increases a liability or revenue. Referring back to our $10,000 loan example, when you receive cash, you will debit your cash account by $10,000. On the other hand, you will credit the notes payable account for the same amount. Debits must always equal credits, and if there is a difference, a mistake has occurred. This is the entry we just talked about. You'll notice that this represents journal entries for the month of April 2021. Have we referenced this as journal entry number 1? You can see where we debited cash for $10,000 and made a credit to accounts payable for $10,000. We also made a note for what that journal entry was for. Journal entry number 2 represents our purchase of the equipment using cash. This shows the debit for our equipment, which is for computers, and the credit to cash, which reduces cash by $10,000. I will now discuss receipts and supporting transaction documents. Receipts are a written acknowledgement that something of value has been transferred from one party to another. If you own a small business, the IRS suggests the typical receipts that should be retained are as follows. Gross receipts such as cash register tapes, cash and credit sales, receipt books, and invoices. Receipts from purchases and raw materials. These should show the amount paid and confirm that they were necessary business purchases. Documents could include canceled checks or other documents that identify the payee, the amount, and proof of fund transfers. Petty cash slips for small cash payments as well. There are a couple ways to file your receipts and documents. If you want to file using hard copies, filing in chronological order by date or document number, making sure that the information is correct before filing. Folders can be organized by month, customer, or other specific files. To be safe, there is the option of scanning files to have a digital backup stored on your computer or an external hard drive. If you would rather file all digital, there are software programs such as Excel or QuickBooks. Each month, reconciliations should be done to match invoices and receipts to bank statements to ensure that everything is correct and there were no accounting errors. Next, I will discuss accounting methods. In accounting, there are 2 ways to record business transactions that occur, the cash method and the accrual method. When starting a business, you'll have to choose which method you would like to use. The cash method is an accounting method where payment receipts are recorded during the period in which they are received, and expenses are recorded in the period in which they are actually paid. In other words, revenues and expenses are recorded when cash is received or paid. The biggest advantage is that it is simple and you always know how much cash you have on hand. This also means that income is not taxed until received, however, it may not reflect when cash is actually earned or spent. The other option is the accrual method. This method records revenue and expenses when a transaction occurs versus when payment is received or made. This method follows the matching principle, which states that revenues and expenses should be recognized in the same period. The biggest advantage is that it smooths out profit and loss. Large payments for something that occurred over a period of time are divided within that period. However, it does take extra work to figure out how to record everything, and you also need to monitor cash flows with a cash flow statement to know how much cash you have on hand. Some things to keep in mind when choosing which method to use is that the method chosen does not affect how much money you bring in, just the timing of the recording. The cash method is best for small businesses, but not as helpful if you have a lot of inventory. The accrual method is required if annual gross receipts for 3 years exceed $25 million, the amount you hold of inventory and gross receipts exceed $1 million per year, or you are a publicly traded company required to follow GAAP. The accrual method is also generally preferred by investors, so it may be helpful if you are looking for funding. You must also keep in mind that you are required to receive IRS approval to change methods after you've already filed taxes using one method. This is to prevent changes made to receive preferential tax treatment. Approved method changes also requires that the business pay the difference made in taxable income for that year.
Now we'll be going over different types of accounting softwares that are typically used. We will start with Excel. If you have a background in accounting or have taken any accounting classes, odds are that you have used Excel. Excel is a useful tool for entering and organizing data as well as completing calculations, both simple and advanced. Excel can be purchased independently or as a part of the Microsoft Office program suite. Separately, it costs about $160, or you can pay $7 a month for the Microsoft Office 365, which also gives you access to other Microsoft programs. Excel's standard price is comparable to many other accounting software programs. The pros of Excel: it has the option to use preset templates that can be used and edited to your liking. Many of these templates come with the program or can be downloaded for free. Additionally, more complex templates can be purchased for an extra fee. You can also make your own templates from the ground up, creating custom forms and workbooks as you see fit. Personalized formulas can be built to quickly select, sort, and compute your data as desired. There are also many different types of graphs and charts to track and show your data. Excel is highly customizable and versatile software to those who are experienced with it. The cons of Excel is it's highly customizable. It works best only if you know how to use it. And the learning curve for Excel can be very steep, especially for its more complex functionalities. Many people attend special training courses to be more proficient with Excel. In addition, if a template or formula is not available for what you need for your business, you may have to make it yourself, which can be time-consuming and frustrating if you're not properly trained or experienced. In large workbooks, you can get lost in the numbers and may accidentally delete or make an error that can destabilize the entirety of your workbook. Finding such errors and correcting them can be difficult and time-consuming. As with most software, Excel files are also susceptible to corruption, leaving the file unusable or the data lost in worst-case scenarios. Some professionals also consider Microsoft Excel to be an unprofessional software. Getting a loan from a bank or other investors based on an Excel spreadsheet can be difficult without a more official setup. In summary, overall Excel provides a world of options that is mostly bound by your own ability with the program. It is useful if you want to handle everything by yourself with no other employees around, or you want a program that can be designed around you specifically. However, Excel does not lend itself easily to outside institutions like banks or payment systems, and data usually must be entered manually, which can be very time-consuming. There are also dedicated accounting softwares. Programs such as QuickBooks and NetSuite lack in customization what they make up for an expanded communication ability, financial form generation, and ease of use. The pros of these types of softwares are that payroll and inventory accounts are significantly easier with dedicated accounting softwares. Most dedicated accounting softwares have specific modules to assist you with payroll, inventory, asset tracking, petty cash, and more. They can also connect to your business's bank accounts and automatically input transactions within the program, saving you from having to manually enter data. Unlike Excel, most dedicated accounting software programs are much easier to learn, and the programs will help you learn the programs within themselves. The cons: first is the price. These programs are not free and often have new paid updates coming out regularly with updated standards for taxes and other accounting practices. The extra cost for the updated standards does reduce the potential for error in your accounting, though. With a dedicated accounting software, there's much less customization afforded to you than is given with Excel, but it is a much better option if you have multiple employees or a more complex business model. I will discuss backing up your data. Life in business can be unpredictable. Sometimes you may have a missed delivery or one of your clients is not pleased with the service or product. These situations can generally be fixed after the fact. However, you might lose that data. What happens if a bad storm fries your computers? There's also situations such as flooding, fire, theft, and data corruption. These are some of the things that can cause all the data essential to your business to disappear in an instant. Salvage may be possible in some instances, but for something as important to you as your accounting information, Prevention is key. The options available to you. There are only a few popular options for data backup and retrieval. Depending on the size of the data being stored, some people use a USB drive for easy transport of relatively small amounts of data. However, for backing up all of your company data, it is recommended that you invest in either a dedicated external hard drive, online storage, or both. For online storage, there are many companies that offer backup services. A lot of companies providing accounting software also provide their own online service. This is a great option for accessing data on the go and whenever you want. However, there are drawbacks because data cannot be accessed without the internet. Dedicated hard drives, on the other hand, are useful in these situations. If the internet is not available, you can access data stored on your dedicated hard drive simply by plugging it in to your computer and retrieving the data you need. The drawback is these are susceptible to damage since they are physical hard drives. Risks can be avoided by ensuring the hard drive is in a safe and protected area when not in use. A few tips that will help you with backing up your data. Your data is only useful if it is accurate. Make sure to regularly save new backup files to keep information current. Do not delete old data. It is a standard practice to keep your financial records for about 7 years. This is in case of audits and other financial adjustments. Hard drives can wear down with time and use. Make sure to replace your hard drives over time to ensure your files do not get corrupted.
I will now discuss developing a budget and a business plan. Establishing your budget is a tool to help establish your goals for the year. To budget your profit and loss for the upcoming year, we need to estimate your revenue and expenses. We will start with expenses. You will first want to determine your fixed and variable costs for each month. Fixed costs will consist of things that will be constant, and variable costs will be the ones that fluctuate. For example, if you have rent, this would normally be a fixed cost as you will be paying the same amount each month. Fixed costs are costs that are not directly impacting the fluctuations of sales. So for your fixed costs, you need to estimate how much each expense will be for the year, such as salaries and office supplies. If your costs are predicted on how much product you produce or service you provide, then this would be a variable cost. Therefore, if you are making a product such as a widget, you would need to determine the number of widgets you are making and then the cost for each widget. This would provide you the cost for each widget and would be broken down by labor and materials. Your budget should include income sources. Therefore, you need to estimate how many products you sell and the price of each product to determine revenue. If it is a service you are providing, you will need to estimate the number of times you will be providing the service and the price you are charging your client for the service to determine your budgeted revenue. You always want to be operating with a profit and should be reevaluating your budget often to ensure that you are staying in budget and to see what areas need improvement. When you modify your budget for the year, this is referred to as your forecast. There are many great budgeting templates online that may help you start your budgeting process. You should compare your budget to your actual revenue and expenses monthly. You can adjust your budget by generating a forecast for the year to show where you will be at the end of the year.
Hello, my name is Eduardo Rosales. I am a senior at the University of Idaho, and I will be discussing the various financial statements that should be generated and reviewed to manage your business. So to start off, the income statement presents a summary of a business revenues and expenses for a portion of time, such as a month, quarter, or year, and it will tell us if the business made a net income or loss. The basic formula for the income statement is revenue minus our expenses equals net income or loss. As you can see from the graph that shows the revenue on top, less costs, which provides net income. Revenue is the money generated from normal business activities and can also be known as gross income, which expenses are subtracted from to determine net income. This normally represents your income in cash. Expenses are the cost of operations that a company incurs to generate revenue. This in turn would be the cash you spend on our operations. Revenue and expenses will be included in the firm's financial statements. The cost of goods sold on an income statement represents the expenses a company has paid to manufacture, source, and ship a product and to the end customer. Gross margin is a required income statement entry that reflects the total revenue minus cost of goods sold. Gross margin is a company's profit before operating expenses, interest payments, and taxes. Gross margin is also known as gross profit. The income statement flows to the balance sheet by taking our net income or loss to the retained earnings. You calculate the retained earnings of that period and use that information in the stockholders' equity section of the balance sheet. This represents a sample income statement. First, notice the income statement is for a time, and in this case, the 12 months ended of December 31st, 2021. Normally, business operates on a calendar year basis, which ends in December. You will notice that there was a sale of $20,000 for total revenue of $20,000. The cost to sell the products or services, cost of goods sold, was $7,500. When we subtract the cost of goods sold from profit, it results in a gross profit of $12,500. We had other expenses to manage the company. In this case, we had salaries, office supplies, travels, insurance, for a total of $5,700. When we reduce the gross profit of $12,500 by the other costs, we have a net income of $6,800. Moving on to the balance sheet, also known as the Statement of Financial Position, this statement lists a business entity's liabilities and equity at a specific point of time, usually at the end of the month, quarter, or year. This document that investors and creditors use to assess the overall health of the company. The equation for the balance sheet is assets equals liabilities plus equity. In this sample balance sheet, as of December 31st, 2021, we have our current assets of cash and accounts receivable at $17,500. We have fixed assets of $2,500 for a total of $20,000. We have liabilities or accounts payable of $1,000. Our owner's equity, which includes our net income of the year, is $19,000. So our assets equals $20,000. Our liabilities and owner's equity of $20,000 as well. Some usefulness of the balance sheet is computing the rate of return as well as analyzing the liquidity and financial flexibility of the company. Moving on to the cash flow statement, shows the cash inflows and outflows of the business. This document only reports that transactions that involve cash not on account, and reports the net increase or decrease in the ending cash balance. This is a simple cash flow which hopefully will give you an idea how to prepare this statement. We start the cash flow by identifying the net income for the period, which is $6,800. We then adjust for non-cash activity, which includes the differences from the prior period for the accounts receivable and accounts payable and depreciation. In this case, we added $500 for depreciation and $200 for increase in accounts payable. When we made a reduction of $100 for $100 in the accounts receivable, resulting in an increase in cash flow for $7,400. This would mean that our cash or bank account increased by $7,400 for the last 12 months. Lastly, the bank reconciliation. Bank reconciliation is a process that occurs ideally every time a statement is received from the bank, monthly, weekly, or daily. This process is where the balance of the cash from a company's own account is compared to the cash of the company's bank account. In this example, the bank is showing a balance of $14,660, and ABC Company is showing a bank balance of $16,000. The process is done in the following steps. First, look at the deposits. Check the transactions amounts recorded from the business and match those that are listed to the bank statements. Next, adjust the amounts to the bank statements to reflect three things: deposits and transactions, outstanding checks, and bank errors. To do this, add deposits and transits, which are any amounts that the business has recorded but not have been yet recognized by the bank. In this example, there was a deposit of $1,500 that was not recorded by the bank. Therefore, there was a deposit in transit. Then subtract or deduct outstanding checks, which similarly deposits and transits have been recorded by the business but not yet by the bank. In this example, there were 2 checks totaling $150, and lastly, correct any other bank errors. In this case, there were no bank errors. Once the bank statement has been adjusted to reflect deposits and transits, outstanding checks, and bank errors, the next step is to modify the cash account in your business. This is simply done by adding bank fees, service charges, or overdraft fees that needs to be recorded. In this case, interest needed to be added to ABC's account balance, so we added an interest charge of $10. The final step of the bank reconciliation process is to check to make sure that your reconciliation worked. That is, that the adjusted bank statement matches the cash balance of the company. If it does not, reconciliation must be done again. In this case, the adjusted bank balance and the adjusted ABC's bank balance matches at $16,010. Hopefully you're getting an understanding of the various financial statements.
To summarize our presentation, we discussed the different forms of businesses and how to register a business. We also covered the 2 methods of accounting, how to record journal entries, and how to choose the right accounting software. We then introduced the basis of creating a budget for a business and the different financial statements to know. Thank you for listening to our presentation. We hope you learned more about the accounting involved in starting a business and will use the information in your business venture.